The structural premise of a global dividend or total market index is to capture world equity yield through a single diversified wrapper. While this strategy successfully smooths return variance and mitigates stock picking risk, it introduces a systemic inefficiency often omitted from fund fact sheets: the tax treaty lottery. Every dividend payment travels through a chain of jurisdictional valves, and each valve represents a tax authority with a legal claim on that cash flow before it can compound. For non-US investors, holding US-domiciled ETFs typically triggers a 30% withholding tax on distributions. This is not a management fee, but a structural leak baked into the citizenship of the fund wrapper itself, remaining entirely outside the index provider's control. The origin of this leak lies in the replication and weighting rules of the fund. In a physically replicating Ireland-domiciled fund, U.S. equities are subject to a 15% withholding tax under the U.S.-Ireland tax treaty. This Level 1 tax is remitted to the IRS before the cash reaches the fund. In contrast, Luxembourg-domiciled physical funds suffer the full 30% rate. This discrepancy exists because Ireland structures its ETFs as corporations that can access treaty benefits, whereas many other jurisdictions cannot. However, synthetic replication offers a mechanical workaround. By using total return swaps, European-domiciled ETFs can often avoid this withholding tax entirely. Under current U.S. tax legislation, swap counterparties can deliver the full, untaxed total return of qualifying indices to the fund. This converts a tax problem into a structural performance edge, allowing synthetic funds to sidestep the drag that physical funds must accept as a cost of ownership.
Quantifying the financial impact of dividend leakage reveals a permanent drag on net asset value. For an Irish-domiciled physical MSCI World ETF, the leakage typically equates to the fund's dividend yield multiplied by its U.S. weighting and the 15% withholding rate. Currently, this results in an annual loss of approximately 0.14% of NAV. On an S&P 500 tracker with a 1.3% yield, the 15% tax consumes roughly 0.195 percentage points of total return every year. While seemingly marginal, this dividend tax leakage compounds into a significant capital loss over decades. Synthetic alternatives, while avoiding this tax, introduce their own costs, such as swap fees and wider bid-ask spreads. Nevertheless, recent data suggests synthetic global trackers maintain a net cost of ownership advantage of roughly 5 basis points over their physical counterparts. Choosing the synthetic route involves a fundamental trade-off, trading tax inefficiency for counterparty risk. Because global indexes are market cap weighted, and U.S. equities represent roughly 68% of that capitalization, global yield is essentially a leveraged bet on U.S. tax treaty terms. To mitigate the tax drag, synthetic structures utilize swap contracts. Under UCITS Article 52, live swap counterparty exposure is capped at 10% of NAV, with daily resets often keeping real exposure between 2 and 5%. While collateralization provides a regulatory backstop, as evidenced by the lack of fund-level losses during the 2008 Lehman default, it requires the investor to underwrite credit risk monitoring. The investor must decide if the structural tax savings justify moving away from the relative safety of physical asset ownership into a regime governed by collateral management and counterparty solvency.
Strategic execution begins with deliberate domicile selection. Since U.S. equities drive the majority of leakage in global funds, capital earmarked for global equity beta should be routed exclusively into Irish-domiciled or synthetic structures. Luxembourg-domiciled physical funds should be avoided where meaningful U.S. exposure exists. It is also a mistake to assume U.S.-listed ETFs are a superior alternative. For non-U.S. investors, these often incur the full 30% statutory withholding rate unless a favorable personal treaty applies. Understanding the Level 2 gate is equally vital. While Level 1 tax occurs between the stocks and the fund, Level 2 tax occurs between the fund and the investor. Distributions from Irish UCITS ETFs generally avoid a second layer of withholding at the fund level, leaving the final tax liability to the investor's home jurisdiction. In tax-advantaged accounts, the 15% Level 1 leak remains unavoidable because the capital is lost before it ever reaches the protected account. The final verdict on global yield is a matter of compounding trajectories. An invisible annual drag of 0.20% functions as a permanent undisclosed fee that degrades the terminal value of a portfolio over a 20-year horizon. For the serious investor, an Irish-domiciled physical structure serves as the rational default, balancing simplicity with improved tax efficiency. For those with high U.S. equity concentrations who are willing to manage counterparty risk, a synthetic, swap-based structure represents a legitimate tactical tilt to close the withholding gate entirely. Ultimately, any physical fund domiciled in a jurisdiction without favorable U.S. treaty access, such as Luxembourg, must be viewed as an overpriced wrapper when an identical index can be tracked through a more tax-efficient Irish counterpart. Success in global indexing requires looking beyond the expense ratio to the jurisdictional plumbing that determines true net returns.